Good afternoon. My name is Chaudhry Mohammad Aziz Anwar, and today I will be presenting my case study analysis on Xiaomi in Africa, scaling smart in an unfamiliar market. This presentation will cover the company background, the core strategic issue analysis using frameworks, evaluation of options, my recommended strategy, and finally my personal reflection. Xiaomi is a Beijing-headquartered consumer electronics company well known for producing high-spec smartphones and competitive prices. After achieving strong position across Asia, Xiaomi entered Africa in 2019 to capture a young and rapidly digitizing population. In markets such as Nigeria, Kenya, and Egypt, Xiaomi has grown, but it continues to trail behind Transition Holdings, Tecno, and Infinix brands. These local competitors are successful because of their deep market insights, dual SIM products, long battery life, and strong retail presence. Xiaomi's global model is centered on online first distribution, universal product design, and influencer marketing. However, the African market demands more localization, such as offline retail in informal markets, telco partnerships, and regional product customization. The key decision point is whether Xiaomi should continue with its globalized strategy or adopt a localized hybrid model. The core strategic issue is clear. Xiaomi must decide between continue with its standardized online first low cost strategy or adopting a localized hybrid strategy for Africa. The challenge is intensified by several triggers: competitive pressure from transition, which dominates with hyper-local designs and strong offline retails; channel mismatch, since Africa still relies heavily on informal retails and telco bundles rather than pure online sales; product usage gaps, and Africa consumer high value long battery endurance, durability, local language support, and reliable after sales; internal tensions with headquarters pushing a standardized playbook while local team advocate for autonomy and localization. Success criteria should focus on sustainable growth in top African markets, positive margin after localization, improved brand preferences, and better after-sale services. Therefore, Xiaomi must calibrate how much localization is justified without losing its cost advantage. The first option is to stay mostly standardized and online first. Strength includes low selling and administrative costs, speed, and preservation of global scale economics. Weakness includes limited reach where informal retail dominates, weaker telco leverage, and product market fit gaps. Opportunities are linked to the rise of e-commerce and social demand. Threats involves entrenched competitors like transaction and consumer trust barriers. From cost-benefit view, this option maintains low complexity and expenses, but risks slower penetration and brand stagnation. The risk is that underperformance may persist and Xiaomi will remain dependent on weak logistic and pure after-sale reputation. The second option is the localized hybrid strategy, which I recommend. This involves blending online strength with offline expansions, telco partnerships, and tailored product tweaks such as large batteries, dual SIM, and regional language packs. Strength: better alignment with consumer purchasing habits, trust from physical presence, affordability through telco bundles, and strong ecosystems. Weaknesses: high cost, organization complexity, and need for local talent. Opportunities: capturing feature phone upgraders, co-marketing with mobile operators, and installment-based financing. Threats: acquisition risk, regulatory challenge, and margin pressure. While costs are high, the benefits include improved market penetration, brand preferences, and strong lifetime value through after-sale and accessory. Compared to option A, This strategy directly addresses Africa core adoption frictions and competitive pressure. From the financial perspective, Xiaomi should adopt a phased capital approach, piloting in three priority markets: Nigeria, Kenya, and Egypt. Budgets should target internal rates of return above 18% while managing working capital through vendor-managed inventory and hedging FX risk. In terms of marketing, Xiaomi should rebalance its mix of 60% trade and field marketing and 40% digital. Community demonstration, bus ranks, activations, and campus engagements can build visibility. Localized content in Swahili, Hausa, and Amharic should be developed with micro-influencer to build trust. Telco bundles should be priced to income levels with installment payment options to improve accessibility. Human resources will play a critical role. Xiaomi needs to hire country-level trade marketing heads, retail promoters, and technical trainers for after-sales. Capability building should focus on training promoters about unique selling points, financing options, and device care. Third-party repair partners should be certified with incentive linked to sale and customer satisfaction. Organizationally, granting major autonomy to the African cluster, especially in pricing and product mix, will allow Xiaomi to remain agile. On the product side, localization must focus on increasing battery life, dual SIM optimization, regional language packs, and rigidized charges. The product portfolio should be tied into the entry-level, core value, and aspirational segments, all adapted for Africa. After-sales services must be strengthened through service boards in high-footfall areas, central spare hubs, and transparent repair pricing. Promotions like screen replacement will help build trust. Performance must be monitored using metrics such as defect rates, repair turnaround time, and spare parts availability. To ensure accountability, Xiaomi should adopt robust management and control system. Key metrics should include country-level profit and losses, promoter productivity, retail coverage, and customer satisfaction through Net Promoter Scores. Governance mechanisms such as monthly planning cadences, trade spend ROI reviews, and audit of channel claim will ensure financial discipline and prevent misuse of resources. My chosen strategy is to adopt localized hybrid model. It directly addresses Africa's purchase realities and close the largest competitive gaps while limiting complexity through a pilot to scale approach. It also improves lifetime value by anchoring accessories and the implementation will follow a 12-month phase plan. Pilot phase, month 1 to 4. Launch shop-in-shops and service pod in Nigeria, Kenya, and Egypt. Sign telco partnerships and introduce Africa-specific SKUs. Validation phase, month 5 to 8. Use dashboard, price tests, and service metrics to refine the approach. Scaling phase, month 9 to 12. Expand successful formats, enhance localized content, and deepen telco core design on promotions. Leadership role will include a dedicated Africa GM, product and after-sale leads, and finance and marketing leads with clear KPI. This case study reinforced for me that strategy must be contextual. Even a strong global playbook can fail if it ignores local realities such as informal retail and after-sale trust. I learned to balance global efficiency with local adaptation by using pilot programs and measurable KPIs. I also recognize the importance of customer empathy, especially around battery life and after-sales support. If I were to repeat this exercise, I would involve telco earlier in co-design financing options and create a cross-functional localization console from day one. The broader lesson is that in emerging market, distribution and trust are just as important as the product itself. Thank you for your time and attention. This concludes my presentation on Xiaomi in Africa. I look forward to your feedback and questions.